Alright guys, good afternoon, good evening, good morning. So today we continue on with our video for accounts 2025 GCE, but today we'll be answering section B. We'll be answering section B 4A question. So this is the question. The question actually reads, there are two questions in this section, 4A and 4B. Answer only one question from this section. Answer either 4A or 4B. Both. Not both, sorry. Write your answers in the spaces provided in the question paper from page 18 to 22. The following accounts or balances extracted from J.C. Mullier's books at the end of the financial year of 31st December 2023. Then there's actually some additional information, and at the end of all this, it's actually requiring us to preparing the income statement and the statement of the financial position of the year. So we're actually going to start first by dealing with the additional information. That's how we're actually going to do with this account. So we start. Our first additional information, I'll just write as working. Just a bit. I'll just write it as working. So hope you can see the additional information. This is it, making. So my first additional information means that depreciation of furniture was at the rate of 10% per annum. So meaning I'm going to write furniture, then I'm going to write depreciation. Or if you want, you can start with depreciation of furniture, either way. Then you're going to get the cost of how much this furniture actually costed us from the above information that we've been given here. So meaning we check how much was our furniture. Our furniture was 20,000. Then you multiply it by the 10% that you've been given to get the depreciation, which will give you 2,000, and that becomes your depreciation right there. Then next you go on to the second one. The second one, which reads that allowance for doubtful debts on accounts receivables was to be maintained at the rate of 5%. So allowance for doubtful debts can also mean provision for doubtful debts. So this was simply just creating like a provision for doubtful debts, meaning because in the information, quite alright, yes, we do have an allowance for doubtful debts on receivables, which is 6,000. But again, to find that in our additional information, we have another one that we are being requested to actually create out of our debtors. So meaning what we'll actually do is say allowance for doubtful debts on accounts receivables. So what we'll do is simply this. We get the amount for the accounts receivables. The accounts receivables amount is 200,000. Since that's where we'll get the new allowance for doubtful debts from the accounts receivables, it simply even states allowance for doubtful debts on accounts receivable. So their accounts receivables was 200,000. Then we multiply it by 5%. We're going to get 5% from it. That's going to be our allowance for doubtful debts. So 200,000 multiplied by 5 divided by 100, which should simply give us 10,000. And this is going to be our allowance for doubtful debts. Allowance for doubtful debts. Don't have space here. And then for our accounts now receivables, For our accounts receivables, what we'll simply do is, since there's a 5% has been extracted from the 200,000, so what we'll simply do is say 200,000 minus 10,000, which will give us 190,000 as our new figure for our accounts receivables. And then we head on to the additional information 3, which reads, at 31st December 2023, salaries of 3,000 were owings and office wages of 2,000 were prepaid. So what you simply do is go on the information and get salaries and wages. And when you look on the information, salaries and wages is going at 30,000. So what you do is say 30,000. You add the owings, then subtract the one that has been paid in advance. So plus the owing, which is 3,000, minus the one that has been paid. So 30,000 plus 3,000 minus 2,000, which will give you 31,000 for your salaries and wages. So you write salaries and wages, which is going at 31,000. Then you head on to your question, to the additional information 4. Additional information 4 reads, office expenses outstanding was 8,000. So you write office expenses outstanding, then these were 8,000. So what you simply do is this. You get the office expenses, which is 12,000, then you add plus the 8,000, which will simply give you 20,000. Then you head on to your fifth one, which says insurance amounting of 2,000 was prepaid. So insurance, which is 2,000, then you check how much was the insurance that we've been given, which was 12,000. And you're going to subtract the 2,000 since it's been prepaid, it's been paid in advance. So what you'll remain with is actually 10,000. Then you head on to your additional information 6, which reads goods taken out for private use. So here the goods that have been taken out for private goods, private use, private purposes, simply meaning drawings. Someone has taken out money from the business for like his own benefit, which is drawings. Then again, there are goods, so meaning purchases is also being affected here. So what's happening is this: goods taken out for private use, meaning the drawing account is going to increase, while the purchases account is going to decrease, simply because you're taking out goods from your business. Then at the same time again, you are going to use them for private use, meaning your drawings is increasing. So when we check on our general information, how much is our drawing, which is 24,000, then we add it plus 6,000, since the one that's the goods taken out for private use was 6,000, so plus 6,000, then which is going to give us how much? This is going to be 30,000. Then the purchases 150,000. And then you're going to subtract the 6,000 now from the purchases, since this amount is like it's affecting two accounts in simple. So we're going to say 150,000 minus 6,000, which is going to give us 144,000. Then the last one, the final one, was a closing inventory, which is 60,000. And just like that, the additional information is done. This additional information is actually very important. Simply what I've simply done here working, this will actually make things much easier for me to actually locate which one will go to the trading profit and loss account, which one will actually go to the balance sheet. This makes things much easier for me, so meaning now I can actually start preparing the accounts. So we start first of all with the title. The title is going to be J Simulators. J Simulators. This is a statement. This is income statement. J Simulators income statement. As at the 1st December 2023. Then we start. Details. The currency, which is K Kwacha for our country Zambia. Then we start. Sales. How much our sales when you take a look at them. This is 321,000. 321,000. Then we check, do we have any returns? Yes, we do. We have sales returns going at 10,000. So sales return, which is going at 10,000, and we subtract. Going to be 321,000 minus 10,000, which will give us 311,000. Then from there, this amount is called actually turnover, or you can actually call it net sales, whichever you prefer. Then from there we go on to our inventory, the opening inventory. Sorry for that. The other name for this, you can actually call them opening stock or closing stock. So the opening inventory is 50,000. Then we head on to purchases. The purchases are going at 150,000. Sorry, there was, in the additional information, you discover that there was something that was affecting the purchases, which was the goods taken out for private use. So it's right here. Our purchases figure from 150,000 was actually decreased to 144. So meaning our purchases amount is, when we did our working here from the one I was doing, which is 144,000. So meaning 144,000. Then I get now the purchases returns. Purchases returns. The purchases return is going at 5,000. So now we subtract 155 or 144,000 minus 5,000, which will give us 139,000. Then from there you simply add plus the 50,000, which will give us 189,000. Then from there you say less inventory, which is the closing inventory. And the closing inventory is going at 60,000. So you subtract from 189,000, you subtract 60,000 from 189,000, which will give you 60,000. So about that, 189,000 minus 60,000, which will give you 129,000. Then from there you say add warehouse wages, because we've got wages. If wages is simply standing on its own, always add it to the, after you've subtracted the I forgot to mention that this amount right here is actually called net purchases. Yes. Then from there you say add warehouse wages. The warehouse wages is going at, this is 20,000. So plus 20,000, which is going to give you 149,000. this is actually what we're calling the cost of sales or cost of goods. And then from there you subtract the 311,000 minus the 149,000, which will give us 162,000 as our gross profit. And now we say add income. Sorry if you actually can't see it very well, it's actually very difficult. Okay, add income. So now the income, we check from the information we have, do we have anything that was actually received? Yes, we do. We have interest received. Interest received, which is going at how much? And the interest received is 4,000. And it seems to be like the only thing we have, so many will say the total is going to be 4,000. Then we add them, the gross profit plus the total income, so plus 4,000, which will give me 166,000. Yes. Then from there, this will be our total income. Then from there now we'll go on to now saying less expenses. So now where majority will start first from our additional information, collecting our expenses. So we start off first from our expenses. So the depreciation for furniture is also an expense, so you're going to say, I'll just abbreviate it due to the space is very small, so I'll just say DP of furniture, which is 2,000. Then again we have salaries and wages. Hope you can see them, salaries and wages, 31,000. What we're doing now, working salaries and wages, which is going at 31,000. Then we also have office expenses outstanding, which is going at 20,000. Then we also have insurance. Insurance is going at 10,000. What else? We also have allowance for doubtful debts. So this allowance for doubtful debts, like I said, in the information you find that you also have an allowance for doubtful debts, the opening one. So the opening one is simply, this is simply the odd one. So the old one was how much? The allowance for doubtful debt was 6,000. The one we were given in the information, although it's saying it's the opening, just write odd. Then the new one that we have is the one that we've actually created from our debtors, and this new one is going at how much? We found it to be 10,000 from our working, which is right here, 10,000. So you simply just say 10,000. Then you ask yourself, was there from the odd one, was there an increase or a decrease? So you will simply notice that the 10,000 from 6,000 to 10,000 was simply an increase. Then you check what increase was there, so you check for the difference. 10,000 minus 6,000, sorry about that, 10,000 minus 6,000, and you will notice that your difference is actually 4,000. So this same 4,000 is actually the one we're going to put under the expenses as our allowance for doubtful debts. Allowance for doubtful debts, which is going to be 4,000. Then what else do we have? Seems like we've put entirely everything. So we check now for more information here if we've got any expenses here: mortgage, capital, furniture, purchases, account receivable, interest received, salaries and wages, we've already dealt with it, sales, purchases, returns, wages, rent. We have rent, and rent is going at 15,000. We check for anything else. Sales, returns, no. Carriage outwards as well is an expense. So carriage outwards is going at 7,000. We check for anything else. There's accounts payable, allowance for doubtful debts. Then we've got printing and stationery. Those are expenses. Which is going at 8,000. We check again. We have insurance expenses. We've dealt with it. Bank overdraft, no. Okay, seems like that's everything, all our expenses. Then we add up the total of everything to find our total expenses. So we're going to say 2,000 plus 31,000 plus 20,000 plus 10,000 plus 4,000 plus 150,000 or 15,000. Is it 15? This is carriage outwards. How much is our carriage? 15,000, yes, plus 7,000 plus 8,000, which is going to give us a total of 97,000. And we subtract, so these are our total expenses. We subtract, which is we subtract this to the 166,000 minus 97,000, which will give me 69,000 as my net profit. And just like that, we're done with the income statement, having our net profit at 69,000. We head on now to the statement of financial position. Right here, required to prepare these two. We're heading on to the second one. So like that, you've gotten your 19 marks, which is quite a lot. So now this is going to be for the statement of financial position. So we start it, the title first, J similarly as statement of financial position as at 31st December 2023. So what's going to happen in this one is actually going to be details, cost. This is the column for depreciation, and the net book value. So the first thing that obviously starts in the balance sheet is actually what's known as the fixed assets. So in the information we're given here, if you check, there's actually one fixed asset here, which is just the furniture. And this fixed asset, the cost of it is 20,000. Then the depreciation of it is what we had found when we were doing our working. The depreciation was 22,000. So you put 2,000. Then you're going to subtract the cost minus the depreciation to find your net book value. So 20,000 minus 2,000, which is going to give you 18,000. Then followed, the next thing that follows now is what's known as current assets. So we start off first with the closing inventory. The closing inventory is going at 60,000. Then we go into the accounts receivables. In the accounts receivables had an adjustment which we had found now working, which is 190,000. So accounts receivable 190,000. Then from there again, there's something I actually forgot to mention is that here for our additional information here where it said 31st December 2023 salaries we are owing of 3,000. So there's this formula I like to use: prepaid, accrued, expenses, assets, liabilities. So what this simply means is that this 3,000 was accrued. The A here means accrued. This means prepaid, paid in advance. This means asset. This means liabilities. This helps me to identify which one will actually go under the current assets column and which transaction will go under the current liabilities column. So in this case, we have an owing. Salaries of 3,000 was owing, so meaning I go here, I write expense, salaries is an expense, then it was accrued, so meaning it's going to go under current liabilities. This 3,000 will go under current liabilities. Then the 2,000 and office wages of 2,000 were prepaid, so I say expenses, prepaid, assets. This one will go under current assets. Same thing here. Outstanding simply also means owing, so this can also mean accrued, so meaning office expenses, so the expenses and or accrued, these ones will go under current liabilities. So current liabilities. Then we had insurance. Insurance was prepaid, so we just say expense, prepaid, current assets. So current asset. So we've got so we'll look at our information. We'll say office wages, since they were prepaid, and we've simply said the 2,000 is going to go under current assets. So office wages, which is 2,000, and then we also have insurance, same amount as well. Insurance also as well, 2,000. So from there now we can add up the total. We'll have 60,000 plus 190,000 plus 2,000 plus 2,000, which will give us 254,000. That's our total current assets. And then we'll go on now to our current liabilities. So for our current liabilities, we'll of course start with the accounts payables. The accounts payable, this is just also simply meaning credit as well. Accounts payable are going at 120,000. And then from there we'll go on to, we also have got bank overdraft. If it was bank alone, it could have gone under the current asset, but this is bank overdraft. It's a credit. It's like simply just trying to tell you your account is running, it's very low, there's no, so the bank overdraft is 2,000. And then from there we look at what on our additional information, what we had. We said the 3,000 which was owing for salaries and wages would be will go under current liabilities. So salaries, which is 3,000. Then we also have another one which was outstanding, office expenses outstanding, which was 8,000. expenses, and that's going at 8,000. Then from there we add up the total of everything. So from there 120 120,000 plus 2,000 plus 3,000 plus 8,000. This will give me 133,000. Then from there we subtract the two, the current assets and the current liabilities. 254,000 minus 133,000, which will give me 121,000. Then you add up plus the fixed assets, which is 18,000, which will give you 139,000. This amount here is what's being referred to as working capital, and this amount is what's being referred to as net asset. Then you actually say financed by, then you say capital. The capital is going at 90,000. Then we get our net profit. The net profit was found as 69,000. We adapted to 90,000. The capital 90,000 plus 69,000, which will give us 159,000. Then we less the drawing, we subtract drawings, less drawings, and to find the drawings, now actual information seem to add an adjustment. Drawings are going now at, instead of getting the ones that are 24,000, we're going to get the ones, the 30,000. So we subtract minus 30,000, which will give us 129,000. Then from there we have long-term liabilities. And our long-term liabilities is mortgage. Mortgage is a loan, so yeah, people actually get it confused. Then we add plus 10,000, and you'll find it to have balanced. This is what we're going to refer to as capital employed. Thank you very much guys for watching. Please like and subscribe for more content like this. Thank you very much.